Final chapter overview, I'm actually looking at what I call an underwriting appendix. So it isn't a full chapter. It dives into how to build a pro forma for developing a ground up multifamily property. So that's what I title it. Underwriting appendix, you want to develop a ground up multifamily property. So you'll see a lot of overlap between the pro forma for analyzing a ground up deal compared to the pro forma for buying a stabilized or existing and leased out apartment building. So I'll highlight as I walk through this some of the differences and then include a link for where you can download this pro forma for free. And I walk through each one of the screenshots in my book. So we begin the same way with confirming rents. However, since the property doesn't exist here, we need to project what the rents are. We don't have actual lease agreements. So this is critical that we work with a real estate professional of some sort who can project market rents so you don't inflate what you think you can collect on rent. This feeds directly into our operating budget. So this is where the rents and any associated fees flow through to the total operating income, and then we look at operating expenses. Similarly, because this property doesn't actually exist, we have to project what those expenses can be. And we typically rely on rules of thumb, so we can't look at a trailing 12 to see what the actual expenses are. And what we're left with, that key metric in commercial real estate, net operating income, or NOI. That NOI feeds directly into determining the property's value using cap rates or capitalization rates, a means of apples to apples commercial properties. So they may not be identical like single family home comps, but similarly located, tenant quality, age, amenities, risk factor. Multifamily properties will have similar cap rates. So we divide our NOI by that cap rate and we're left with a projected value. That value then flows into our budget. So I'll zoom out here a little bit, but unlike a stabilized acquisition, we're not just looking at purchasing something and then beginning to operate it. We have to purchase the land or building that we plan to raise and then build, and then we have to look at the construction costs. So here we're looking at the site work and vertical construction costs, the GC's overhead and profit, the contingency, or what I like to call a safety buffer, assuming that the GC contract will ultimately need to be increased somewhat. So this contingency just builds a planning factor and buffer for that. And then we look at the soft costs, all these costs that are critical to building a property that don't directly tie into the general contractor's contract amount. So things like architectural engineering fees, real estate taxes during the construction period, insurance, marketing, fees and permits to actually connect with the local municipalities' utilities and gain approval to build. And what we ultimately get is our total cost before debt, and then assuming we're going to use a construction loan, our loan interest and construction loan fees, which you'll see feeds from a later step. But what that ultimately gives us our total project costs. So that's the cost before debt plus the debt-related costs for construction. This feeds directly into what we're looking at for debt financing. So the stabilized property, we're only looking at the permanent loan, whereas in construction loans or a ground-up project, we have to look at both the construction loan and the permanent financing, so that long-term mortgage we're going to secure once we've stabilized or leased out the property. And what you'll typically see is that the construction loan, the maximum amount is going to be limited by the size of the permanent loan. So typically, lenders won't provide a construction loan that's greater than the ultimate permanent loan, because the permanent loan will pay off the construction loan. So lenders won't want to assume that risk. So that's why we have to calculate both those together, both the permanent loan and the construction loan. We next have to look at the project timeline. So this is a big chart because we're basically looking at, during the development and construction period, what sort of costs are going into this build and what are the timelines. Because when we're looking at a long-term project like this, we have to account for the time value of money and the fact that certain costs are going to be incurred gradually over time. So the general contract or a general contractor's contract, the hard costs, you're not going to pay that immediately. It's It's going to be paid out over time as construction continues to progress. And this just gives us a way to look at breaking down the different timelines we assume. So in this example, I assume a 21-month total development period or project period. So that's from going under contract all the way to stabilizing or leasing out your property. These are just example numbers, but the point being, with a ground up deal, you can't assume it happens instantaneously. You have to account for the time value of money and the fact that it will take you some time to actually acquire, permit, and build a multifamily property. So you see down in the bottom the project net cash flows. So in each month, how much cash is going out, in this case negative numbers, as opposed to how much cash is coming in. Ultimately settling with the refi where the permanent loan closes out the construction loan balance. With this project timeline built, we can confirm our sources and uses. So you'll notice that there are two sources and uses section here. Whereas stabilizing or buying a stabilized apartment building, we're just looking at acquisition. For a ground up deal, we have to look at both the sources and uses during the acquisition and construction, and you'll see they tally as our check to make sure our sources equal our uses. But then we also have to look at the sources and uses for closing on the permanent loan, and these also tally here. With the sources and uses, we can go into our projecting of cash flows, investment returns, and this looks very similar to projecting the 10-year returns of a stabilized apartment building, but you'll see that in years 1 and 2, we have our project net cash flows spread out because it's going to take time to acquire, entitle, and build that property. But we're ultimately left with, similarly, our projected total returns on the deal. So this is the deal level return of internal rate of return, our IRR, our profit, our total peak equity, and our equity multiple. From here, assuming we have different classes of equity, we go into our equity waterfall. And similar to the stabilized acquisition, this lets us tier our different classes of equity. In this case, we have our sponsor receiving promoted equity interests in Tier 2. In Tier 1, it's the return of capital and hitting the limited partner or investor members' required return of 8%. So once the deal's cash flows exceed 8%, the remaining money funnels down into Tier 2, where the sponsor receives his promoted interest or promotes, so a disproportionate level of returns. That incentive, those promotes, mean that at the end of the deal, as projected, the investors receive a slightly lower IRR than the deal level total, whereas the sponsor receives a slightly higher, or in this case, significantly higher IRR as an incentive to perform well on the deal. That's a example of ground up multifamily pro forma. I invite you to download it, play with it, add more detail, do what you need to do, make it your own, but please see a link below and download a copy and start playing with it. No need to reinvent the wheel, use this foundation, and thanks again for the support.